Hey guys, Brown Asset Management here, and today I'm looking at the General Electric Company, ticker symbol GE, using my 7 simple steps. Let's have a look at the share price over the last 2 years. So pre-pandemic it was around about $13 a share, and then got absolutely hammered, went down to almost $6 a share, and then hit its 52-week low at $5.48 a share. And very surprisingly, it's gone on a pretty strong rebound, hit a 52-week high at $14.42 a share, but is now at around $12.77. I just want to quickly look at the all chart and see the story of General Electric on the whole term. I mean, look at that chart. It's gone up and then gone down, and it's gone up and it's gone down, and it's gone up and it's gone down. So it's not looking good about the stock price, but let's have a look at my 7 steps. So step number 1 is the PE ratio less than the market, and the PE ratio of General Electric is 22.09, and the market is 40, so that is a pass. Now I want to compare it against the sector, which is industrials, and that has a PE ratio currently of 42.5, so that's 2 passes off the bounce. It's got a very low PE ratio. Now we want to see, has the revenue increased over the last 5 years, and it has not. It has gone from 120 billion to 80 billion, so that is a fail and a very negative trend here. Now we want to see, is the profit increasing, and the profit has actually gone from minus 6 billion to 5 billion profit. But look at these numbers: minus 6 billion, minus 22 billion, minus 5 billion, and then 6 billion. So this number does look a bit of an aberration, but a pass nonetheless. So heading over to the balance sheet, and I'm kind of hoping General Electric are buying back their shares to try and reward shareholders, but they're not. It's gone from 8.68 billion to 8.73 billion. So that's a fail again. Just want to say thank you guys for watching. Please leave a like if you enjoyed the video, give a comment on your thoughts on General Electric, and consider subscribing if you enjoy stock analysis videos. Now on to my next step: are the current assets greater than the current liabilities? So General Electric's current assets are 96 billion, whereas the current liabilities are 56 billion. So that is a pass. You can see that the liabilities have been decreasing and also the assets have been decreasing, but they look they're in line, so they're really slimming down. And finally is the free cash flow increasing, and the free cash flow has gone from 2.5 billion to just under 200 million, so that's a massive fail again. You can see these numbers have gone from 2.5 billion to minus almost 4 billion, 2.7 billion, and then 200 million. So these numbers are all over the place again, but it is a fail. So General Electric does pay a dividend, but it's a pretty sorry one if I do say so. It has an annual dividend of 4 cents a share with a dividend yield of 0.32%. Look at this graph. They've massively slashed their dividend at the end of 2018. It is a very safe dividend with 2.83% of the cash flow, but it's not a very big dividend. They are going to increase it. Oh no, sorry. That was when they decreased it in 2018. 11-cent decrease. Massive. So in terms of my steps, it's not looking great, but let's see what the analysts think. The analysts surprisingly have it at a moderate buy, 8 buying and 5 holding, with a average share price of $13.50 a share, which is a 6% upside. Then has it on the high side of $17 a share, which I think is incredibly bullish, and on the lower side around $5, which could be more realistic, unfortunately. Very surprised by Simply Wall Street here. They have it 23% undervalued with a fair value of $16.33 a share. Based on Simply Wall Street using the discounted free cash flow model, I am surprised that they have it undervalued. So just to quickly summarize, General Electric has a market cap of 111 billion and a share price of, currently it is changing, but $12.65. The PE ratios were a pass with 20.96, and that was less than the market and the sector, so 2 passes. Revenue has not increased. It went from 20 billion to 80 billion, so that was a fail. Profit went from a negative to a positive with minus 6 billion to 5 billion, so that was a pass. They haven't been buying back their shares. They've been issuing more, so that was a fail. And the current assets can pay off the current liabilities with 96 billion to 56 billion, and they're slimming down their company. And unfortunately, finally, the free cash flow has not increased from 2.5 billion to just under 200 million, so that was a fail. So that is 4 passes and 3 fails, but the fails do tell a pretty grim story with the decreasing revenue and the decreasing free cash flow. So that gives an average free cash flow of 400 million, which is very low, and gives a current free cash flow yield of 0.14% and a current free cash flow ratio of 708. So if you want to get a company with very high free cash flow ratios, probably worth you buying a company like Tesla rather than General Electric. I'm quite surprised that analysts are so bullish on this stock. And finally, to my valuations here, I have a discounted free cash flow model, and I have gone on the bullish side. As you can see, I've assumed that General Electric are going to be increasing their free cash flow in line with their 2019 and 2017 number, not their 2018 and 2020 number. So I have been very bullish on the free cash flow, and that gives me a calculated stock price of $8.03 a share, which means it's almost 40% overvalued at the minute. Now looking at the Buffett Graham intrinsic value, it has a earnings per share of 0.58. It has an earnings per share of 0.58. I've given an expected growth rate of 7.24%, and that gives a fair value of $8.89, whereas a Graham price of $6.52. So neither model says it's a buy. The models are quite in line. They both think it's around $8 a share, but neither saying that it's a buy. I was looking at General Electric when it was around $6 a share, so that would have been a good buying opportunity, but I do think it is overvalued at the minute. So my models don't have it as a buy, but let's see if it's a buy according to the technicals. So I have the share price in blue, a 50-day in green, and a 200 in gold. So if we're looking at the last time there was a very bullish signal, the price crossed the 50-day in October, so that was a buy sign. The price crossed the 200-day in November, that would have been another buy signal. And then there was a golden cross in November when the shorter moving average 50 crossed the 200-day. So there's been a lot of bullish signals in the recent times to buy, and if you bought at any of these, you would have made a good amount of money. And looking overall, the 200-day started an upswing, and looks like the 50 moving day average has provided a little bit of resistance at the current price. You can see that it did cross it briefly, but whenever it's got close to it, it's actually fired back up. So these next few months will be telling, but if you were looking at these averages back in October and November, you would have bought and made some money, and you'd still be holding on now. Right guys, I want to thank you all for watching. Please leave a like if you enjoyed the video. Give a comment on your thoughts on GE and if you think it's a buy, or do you agree with me and think it's not. And please consider subscribing if you enjoy investing and stock analysis videos, and I'll catch you guys next time.